When it comes to filing taxes, many people find themselves confused by the terminology and various strategies to reduce their tax liability. Tax deductions and tax credits are two powerful tools that can help you save money when it comes to taxes. However, these terms are often misunderstood or used interchangeably, which can lead to confusion. In this article, we'll dive deep into the differences between tax deductions and tax credits, how they work, and how you can take advantage of them to reduce the amount you owe to the IRS. A tax deduction reduces the amount of income that is subject to taxation. Essentially, it lowers your taxable income, which can lead to a lower tax bill. Deductions are subtracted from your total income to determine how much of your income is actually taxable. In turn, the smaller your taxable income, the less you may owe in taxes. There are two main types of tax deductions. 1. Standard deduction. The standard deduction is a fixed amount set by the IRS, and it's available to most taxpayers. You can claim this deduction without needing to provide any detailed expenses. The amount of the standard deduction varies based on your filing status. For instance, in 2023, the standard deduction is $27,700 for married couples filing jointly, $13,850 for single filers and married individuals filing separately, and $20,800 for heads of household. The standard deduction is often a more straightforward option for taxpayers who don't have significant qualifying expenses or who don't want to spend time tracking detailed deductions. 2. Itemized deductions. Itemized deductions allow you to deduct specific expenses you've incurred during the year, and they may result in a larger deduction than the standard deduction. However, you must have enough expenses to make itemizing worthwhile. Common itemized deductions include medical and dental expenses exceeding 7.5% of your adjusted gross income, state and local taxes up to a maximum of $10,000, mortgage interest on your primary residence or second home, charitable contributions, casualty and theft losses, and unreimbursed employee expenses for work-related costs. Itemizing can be more complex and time-consuming because you'll need to track receipts and documents for all eligible expenses. To understand how tax deductions reduce your taxable income, let's walk through a simplified example. Imagine you are a single filer with an income of $60,000. If you take the standard deduction of $13,850, your taxable income would be reduced to $46,150. If you itemize and have $20,000 in qualifying deductions, your taxable income would be reduced to $40,000. In both scenarios, your tax liability would be based on the reduced taxable income, which can lower the overall amount you owe in taxes. A tax credit directly reduces the amount of taxes you owe on a dollar-for-dollar basis. Unlike deductions, which lower your taxable income, tax credits lower your actual tax bill. This makes them more valuable than deductions because they provide a direct reduction in your tax liability. There are two types of tax credits. First, nonrefundable tax credits. These credits reduce the amount of tax you owe, but they cannot reduce your tax liability to less than zero. In other words, if your tax liability is lower than the credit, you forfeit the remaining amount of the credit. For example, if you owe $2,000 in taxes and are eligible for a nonrefundable credit of $3,000, your tax bill will be reduced to zero, but you will lose the remaining $1,000. Common non-refundable credits include the child tax credit and the lifetime learning credit. Second, refundable tax credits. Refundable credits are more powerful because they can reduce your tax liability below zero, meaning the government will send you a refund if your credits exceed the amount you owe in taxes. For example, if your tax liability is $1,500 and you qualify for a $2,000 refundable tax credit, your tax bill will be reduced to zero and you'll receive a $500 refund. Examples of refundable credits include the Earned Income Tax Credit, also known as EITC, and the Additional Child Tax Credit. Let's use an example to understand how tax credits can impact your tax bill. Suppose you are a married couple filing jointly with a taxable income of $70,000. Your total tax liability is calculated based on the applicable tax brackets. After determining your tax bill, let's say it's $8,000, you apply tax credits. If you qualify for a $2,000 tax credit, such as the child tax credit, your tax bill is reduced by the full $2,000, lowering your total liability to $6,000. If the credit were refundable and you owed only $1,500 in taxes, you would receive a refund for the remaining $500 of the credit. While both tax deductions and tax credits help you reduce your overall tax liability, they work in different ways. Tax deductions reduce your taxable income, which means they lower the portion of your income that is subject to tax. In contrast, tax credits directly reduce your tax liability, meaning they subtract directly from the amount of taxes you owe. When it comes to calculation, deductions are subtracted from your total income, whereas credits are subtracted directly from your tax bill. There are different types of deductions and credits. Deductions can be standard or itemized, while credits can be non-refundable or refundable. The impact of these is also different. Deductions reduce your taxable income, potentially lowering your overall tax bracket. On the other hand, credits reduce the actual tax amount owed, and refundable credits may even lead to a refund. For example, common tax deductions include the standard deduction, mortgage interest, and charitable donations. Examples of tax credits include the child tax credit and the earned income tax credit, or EITC. Let's talk about some common tax deductions and credits. Common tax deductions include 1. Mortgage interest. Homeowners can often deduct interest paid on their mortgage, which can be a significant deduction, especially in the early years of the mortgage when most of the payment is interest. 2. Charitable contributions. Donations to qualified charitable organizations can be deducted. This includes both cash donations and the fair market value of donated goods. 3. Medical expenses. If you itemize, you may deduct medical expenses that exceed 7.5% of your adjusted gross income, or AGI. 4. State and local taxes, also known as SALT. This deduction allows you to deduct state and local income taxes or sales taxes, property taxes, and other eligible taxes up to a maximum of $10,000. 5. Education costs. Certain education expenses, such as student loan interest or tuition, may qualify for deductions. Now let's look at some common tax credits. 1. The child tax credit. Parents of children under the age of 17 may qualify for a tax credit of up to $2,000 per child. This credit is partially refundable. 2. The Earned Income Tax Credit, or EITC. Designed for low to moderate income workers, the EITC reduces the amount of taxes owed and may result in a refund. The credit is based on income, number of dependents, and filing status. 3. The American Opportunity Credit. This credit provides up to $2,500 per eligible student for qualified education expenses, such as tuition, fees, and course materials. It's partially refundable. 4. The Lifetime Learning Credit, a credit worth up to $2,000 per tax return for qualified education expenses, primarily aimed at undergraduate and graduate students. 5. Energy Efficiency Credits. Certain credits are available for those who make energy-efficient improvements to their homes, such as installing solar panels or energy-efficient windows. Here are some tips on how to maximize your tax deductions and credits. 1. Track your expenses. To maximize deductions, keep detailed records of qualifying expenses throughout the year, such as medical bills, charitable donations, and business-related costs. 2. Take advantage of both. Don't just rely on either deductions or credits. Use both where possible. For example, you can deduct mortgage interest, which is a deduction, and claim the child tax credit, which is a credit, in the same tax year. 3. Consult a tax professional. Navigating the complex rules surrounding tax deductions and credits can be challenging. A tax professional can help ensure you're taking full advantage of all available deductions and credits. 4. Plan ahead. Some credits and deductions have income limits, so plan your finances accordingly to avoid missing out on valuable tax-saving opportunities. Understanding the differences between tax deductions and tax credits is essential to making the most of your tax situation. Deductions reduce your taxable income, while credits directly reduce the amount of tax you owe. By knowing which deductions and credits you qualify for, and by keeping organized records, you can significantly reduce your tax liability and potentially receive a refund. Whether you are a homeowner, a student, a parent, or a low-income worker, there are various ways to reduce your taxes. Always consult with a tax professional to ensure you're using the best strategies for your unique financial situation.